Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 207 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Morning, Mark.
Before we begin, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track, and these numbers are as of the market close on June 28th, and this data is from YCharts. S&P 500 index up 4.7% for the month of July and up 14% year to date. Dow Jones Industrial Average up 2.9% for the month and up 2.1% for the year. The NASDAQ Composite Index up 5.1% for the month and up 29.9% for the year. The Russell 2000 Small Cap Index up 6% for the month and up 5.7% for the year. And the Vanguard All World X United States ETF up 2.5% for the month and 7.5% for the year. The 3-month Treasury rate sitting at 5.44%, the 2-year Treasury rate at 4.71%, and the 10-year Treasury rate at 3.7%. So sticking on that interest rate topic, Matt, first big headline or current event for this week was, kind of looking more and more likely like the Fed is not going to cut rates before the end of this year after Fed Chair Powell spoke earlier this week. The Fed futures, which we have discussed on this podcast in previous shows just recently, so Jenna will link to that podcast in our show notes here if people want to go back and listen to that. But the Fed futures are showing a very low probability of a rate cut before the end of the year.
Okay.
Next, we have the Conference Board's Index of Leading Indicators. So the leading indicators, which kind of could, in some people's mind, forecast a recession on the horizon, declined in May for the 14th straight month. Since 1959, the current period ranks as the third longest streak of monthly declines and just the fourth streak lasting a year or more. Of the three prior periods, the economy was already in a recession by the time the streak reached its 12-month, and again, we're in the 14th straight month of decline. So,
very interesting.
What do you take from that?
First of all, we only know about recessions in hindsight, and we could very well be in one. I know that GDP was revised for Q1, and it was still a positive 2%. But, a lot of these indicators behind the scenes are not great. And the thing that gets me going as a stock investor right now is the resiliency of corporate earnings in the face of a quote-unquote sluggish economy. What the heck do you think happens when we start having a good economy?
Right.
Oh, my goodness.
Right.
So it's interesting to me.
Yeah, very. First thing I have, Matt, is a graphic from Bank of America showing the history of their biggest tail risk survey that is sent to fund managers. So what this is going to do is going to go back all the way to July of 2011.
Oh, this is a great idea.
And fund managers answer the survey and say, hey, what's the biggest headline risk, essentially, right? So from July of 2011 to about October of 2012, the EU sovereign debt funding was the biggest headline risk. And Jen will throw this up on the YouTube video and in the show notes for people that are just listening.
And everyone was an expert on it. Everyone was an expert in Italian debt, Greek debt. Everyone was an expert.
Right. So then it shifted from being international issues to homeland issues. And from October of 2012 to July of 2013, the U.S. fiscal cliff was the biggest issue. From July of 2013 to October of 2014, the China hard landing was a big issue. Mm-hmm. Then from October of 14 to July of 15, the geopolitical crisis. And then we flipped back to the China hard landing in 2015 of October to July of 2016. Then July of 2016 till about October of 2016 was the Trump election, was the biggest headline risk, which was interesting because right after the election, I think just going off of memory, stocks did really well, or they rallied the next day. So that was interesting that even fund managers get it wrong, right?
Yep, they did.
2016 to 2017, EU disintegration. So you had the Brexit vote. And then from 2017 through 2018, you had the Fed, the European Central Bank policy mistakes. After that, you had the U.S.-China trade war, the 2020 presidential election, COVID, obviously, from 2020 through 2021. And then since then, really has been driven by the inflation/hawkish central banks, meaning banks keeping rates higher for longer. And then thrown in there from 2021 until today is the Russia-Ukraine war, a global recession, a systematic credit event, high inflation, keeping central banks hawkish. So again, it really flip-flops, every couple of years. What's the biggest quote-unquote tail risk? But again, I don't think a tail risk isn't something, in my opinion, that is out there and people know about, right? A tail risk is something that no one's talking about that just shocks the system, right?
Exactly.
And I think that's what COVID was, but this obviously survey goes out in hindsight. So, the survey that went out in April of 2020 is when COVID was the biggest headline risk. Yep. That was after the worst of it, right?
Correct.
So the biggest risks to the market are things that people are not talking about. So what's going to bring the market down next at some point in the future? I would bet my money it's nothing that anyone is thinking of right now.
Because it's not priced in.
Correct. So I thought that was a good graphic that was from BofA.
I think this is good. My only other comment I'd like to throw out there is these are some scary headlines through the years that would cause people to change their plans, get out of the market. I'll get back in, Mark, when I think times are better, when I'm more comfortable, right? And what do you think the market's done since 2011?
It's rallied big time.
Yeah, it's just got to keep in mind, I think a lot of investors who might not be in this market right now, you got to think of this. What is the time horizon for this money and invest appropriately? Because timing this market, even with volatility coming in, is extremely challenging.
Yeah, agreed. Second thing I had was a tweet from Bespoke on June 23rd. This will be up on the YouTube page, but they said since the S&P 500 peaked on June 15th, it has been the worst performers year to date, leading the declines. Would have expected it to be the other way around, with the biggest winners pulling back the most. And what you can see in this graphic is that they have deciles based on year-to-date performance. So the best decile all the way on the left side of the graph are the companies that have had the best performance year to date.
Got it.
And it shows the average decline since June 15th is when the little sell-off we had started.
Yep.
And you can look all the way over to the right side of the graph is that the worst decile performers year to date have actually done the worst since June of 2015. So to me, this is telling me, hey, the strongest areas of the market so far year to date are continuing to lead even in the face of a pullback that we've seen for the past week or so. And I think this is a hard concept for people to grasp, which we talk about all the time. We call it relative strength, is that, the strongest names tend to continue to lead for a long period of time. And I think people automatically think that, well, we're halfway through the year, NVIDIA's up 170% or whatever it is. That's got to be one of the names that really pulls back significantly in June. And just based on this data, that's just not the case.
Yeah, and something you and I've talked about is you go into the end of a quarter like we are right now, and you have window dressing. And the definition of window dressing is these money managers, they're going to show their shareholders what they own at the end of the quarter. And so they may not have owned some of those top performers, say such as an NVIDIA, but you know what they're going to do? They're going to buy it at the end of the quarter and be like, hey, I was smart. I own this name during the quarter, when they might have bought it 2 days before the end of the quarter, right? Mm-hmm. And so that's interesting because, you could continue to see some strength in those names in the last couple of days as money managers want to appear smart.
Yeah.
And again, not a recommendation for or against any specific names. such as in NVIDIA.
Yeah. Last thing I have is a tweet from Charlie Bolello on June 16th. He says, after the March 2000 dot-com bubble peak, it took this tech sector nearly 17 years before hitting a new high, suffering an 82% drawdown along the way. Today, the tech sector is back at an all-time high less than 16 months after the December 21 peak. Every bear market is different. I just thought that this was good because I think there were a lot of people for a second there thought that, we were going to have another decline in tech like we did in March of 2000. But, just because that happened in the past doesn't mean that every decline has to look like that. So, I think we weren't the only ones pounding the table on it, but there are a lot of people pounding the table on the fact that, hey, this is not the same thing as March of 2000, completely different environment. And we're already, back to all-time highs in the tech sector, which is being used as XLK, which is the S&P Tech Sector ETF.
Now, it's interesting because it's going to transition to me now. It's interesting you picked this because my first piece is from Charlie Bolello on June 25th, Mark. And the title of this piece for me is Every Bull Bear Market is Different.
It's got a theme in June.
Interesting, my friend. Okay, so throughout 2022, there were many comparisons, Mark, to the 2000 to 2002 bear market and the 2007 to 2009 bear markets, with the implication being that there was still more downside ahead of the market. While that was certainly one possibility, it wasn't the only possibility. And what we've seen over the last 8 months is a path very much unlike those other two bear markets that were being touted. So Jen's going to put up this chart for our YouTube viewers. This will be in our show notes. This is a chart by Charlie showing those previous two bear markets that were being very much compared to. And it shows, Mark, the number of trading days into that bear market. And it overlays the charts of the S&P 500 index versus the 2000-2002 bear market, the 07 to 09, and what was happening so far currently as we've kind of come out of this bear market. And what's your thoughts when you kind of see this chart?
I mean, I don't want to sound repetitive, but it is. Every bear market's different. They look very similar when they start, but
that's the thing. That's the thing right there.
Okay.
They all
Say no
look,
more.
They all look real similar at the beginning.
They do.
And then the narratives start attacking the market. And then when you start talking, when you think about bear market, you think about recessions. You're not thinking of a sell-off of 25% and it comes back, say, within a year. People are thinking of 2007 to 2009. They're thinking of 2000 to 2002. Oh, it's going to be exactly like that. And it might start like it. But then once you kind of have that disconnection, we're in the disbelief phase is where we're at right now.
Yeah, for sure. And that's part of the recovery process.
All right, my next piece is an update on the supply chain. We were all supply chain experts during COVID.
Yeah.
Okay. So the source is Charlie Bolello on June 25th. I'm going to read this from Charlie. We have continued evidence of an improving supply chain, Mark, with the global container freight rates, that's the cost of 40-foot containers, at their lowest levels since 2019, down 88% from their peak.
Wow.
Jen's going to put up this chart for our YouTube viewers. This will be in our show notes.
It's lower than pre-COVID levels.
Correct. This data set goes back to 2017. You're going to see this cost. I mean, for a while there, it was like $14,000 to move a container ship just across the sea. And what's it down to? Like less than $2,000.
Yeah.
Right? Now, next, over a period of 18 months, this is the important part, so I want everyone to perk up. Over a period of 18 months, the New York Fed's Supply Chain Pressure Index has moved from its worst level ever in December of 2021 to its best level ever in May of 2023. Jen will put up this chart again for our YouTube viewers. Mark, this will be in our show notes for our traditional podcast listeners. So, for the most part, the supply chains have really significantly eased. And so I'm going to forecast one thing. If we head out to earnings season coming up here in about roughly, what do you think, 3 weeks? Okay. If companies are blaming I missed earnings because of supply chain issues, that excuse is starting to get expired on the shelf. That excuse was popular for corporate America, but it's a little hard to use that excuse right now.
Yeah, for sure. Okay, I was reading research the other day, and someone was making the argument for why inflation was going to stick around for longer. And one thing he said I just couldn't really wrap my brain around, so I'm wondering if you can help me with that.
Okay.
But he said as we go back to our global trade and global supply chains get better, that was one of his arguments that inflation was going to remain high. But to me, that's very deflationary in my opinion. So I wasn't following exactly where he was going with that.
Do you think like his argument is like we go back to just-in-time delivery, right? Mm-hmm. Is his theory there that it keeps inflation high? I don't know, because I think that corporate America learned a very valuable lesson during COVID. And though to a certain extent we might go back to that, I think a lot of companies are going to be real smart and say, listen, if I can't source this from someone else and I have one vendor who's going to make this, I'm going to have excess inventory of this so it doesn't stop my production line. Mm-hmm. I just think corporate America, when it comes to logistics and just-in-time delivery, this is going to dramatically change how companies think going forward.
Yeah. Yep.
All right, my last piece is I'm going to update some statistics from last year, okay? Last year, in the second quarter, Mark, was a horrible quarter for the stock market. Mm-hmm. And for our listeners, Mark discussed this tweet from Carl Cantanilla back in episode number 158.
Going back in the archives.
Going back, baby. So, there is a tweet that Carl had. Jenna will put this up for our YouTube viewers. This will be in our show notes. He showed, and this is from June 30th of last year, Mark, he showed the piece from Bespoke, 15% plus quarterly drops for the S&P 500 index since World War II. You're going to see the data set, and why I picked this is, what was the average return 1 year later? And what you're going to see from this data set a year ago is the average return 1 year later was about 26%. I'm throwing this out there because when we were talking about this, a lot of people's thoughts and opinions is there is no way this market could be positive 1 year from now. I don't care what this data set says, Matt. There's no way. Mm-hmm. So I just went into stock charts, and Mark, I did this on June 26th, and the S&P 500 from that date of July 1st of last year through June 26th, the numbers aren't over yet, it was up 14.64%. So, why am I highlighting this? Just as much as the market seemed it wouldn't stop going down last year, this year has been positive overall. There will come a time when the market consolidates, pulls back, market corrections are normal. Things seemed bleak last year. We're conveying a general message last year that this too shall pass. So far, that has come true. I am very proud of the content that we produce on this podcast, Mark. We help investors and clients stay focused on their long-term goals and objectives rather than being quick to make decisions on the latest media headline.
Yeah, and I think that's the thing. We try to keep people from making decisions that are going to hurt them in the long run. And I want to stay away from dumb decisions because I don't think it's dumb decisions. It's just keeping people from making emotionally based decisions, I think, is the best way to put it. And that's why I love doing this week in and week out, is hopefully, someone listens to this, even if it's one episode a year, and they get something from it. and it helps them in their decision-making process.
Well said.
So
Before we have Jack on, he is our intern here for the summer at Jessup Wealth Management, Jack McGrath. Is there anything you'd like to say, sir, before I invite him on?
no, I don't think so. End of the quarter tomorrow. Can't believe we are already halfway through 2023. Like we mentioned last week or a few weeks ago, earnings season's going to kick up here in a couple weeks.
Good reminder.
So, no, I don't think so. Just keep chugging along. Hope everyone enjoys their summer.
And a good 4th of July weekend.
And a good 4th of July weekend.
All right.
Yes.
Well, thank you, Mark. All right. So instead of our financial planning topic of the week, we're going to switch it up and welcome again our financial planning intern, Jack, on the podcast to discuss some research he completed on a topic we discussed a couple episodes ago. So first of all, Jack, welcome to the show.
Thank you. Yeah, thanks for having me on.
You're very welcome. So several times this year, we've talked about how only a few stocks were responsible for the majority of the gains in the market this year. This reminded Jack of something called the Pareto Distribution, which he will explain to our listeners. Jenna, how'd I do there? Okay, I got the thumbs up from Jenna. There was some good times when I was trying to pronounce that before the podcast began with an Italian accent.
Yeah, you killed it. Yeah.
I did. Thank you, Jack. All right, so I'm going to turn this over to you. What do you got for us?
So basically the idea that a small number of a large number of outcomes are caused by a small number of causes is pretty much like a law of nature in many things. Like it's responsible, like the largest, like there's a small number of trees in the Amazon rainforest that are the largest.
Got it.
Stuff like that. And that's the same for the market too. Pretty much all the time, just 20% of stocks are responsible for 80% of the market sales and the market cap.
Okay.
And in the same way of like, it kind of makes sense of like, think about when you're trying to listen to music.
Yep.
You don't just go and click on a random song you've never heard before from every song that's ever been recorded. You go and you see, okay, well, let's see what the top 40 songs are right now.
Yep. Or you go within your genre.
Exactly. Yeah, top 40 in the genre, something like that. It's the same with the market. People want to see what stocks are doing well.
Sure.
And then if they invest in those stocks that are doing well, then those stocks do better. And so it makes sense.
Sure. Kind of like that relative strength that Mark was talking about earlier.
Exactly. Yeah. And so it's actually pretty interesting too that 1.3% of firms accounted for $44.7 trillion in global wealth creation from 1990 to 2018.
1.3%.
Yeah. So it's that same thing. A very small number of names in the market accounted for a vast amount of wealth creation.
Interesting. And that wasn't billion, that was trillion.
Trillion.
Yeah.
$1 trillion. Yeah. And so I just thought that was super interesting because we hear a lot of recently like, okay, there's like 7 or 8 names that are really pushing the market right now. Like we have Apple, Amazon, of course, but recently Nvidia, Tesla, stuff like that. And we've been hearing that a lot. But I think it's very interesting that that's pretty much always been the case, that there's a small number of stocks that carry a lot of weight in the market. And so I have this chart here, I hope Jenna can put this up, that shows the percentage of the total weight of the market that is held by the top 5 stocks. And recently, actually, it's pretty low from a historical standpoint.
Really?
Like in 1964, I think it was the peak. It was almost 30%.
So again, what number of the top? 10?
Top 5.
Top 5.
So in 1964, the top 5 stocks accounted for 30% of the S&P 500.
So we got to remember, listeners and viewers, that the S&P 500 is a market cap weighted index, which means the stocks with their outstanding number of shares multiplied by the last sales price, that gives you the market capitalization. So Apple, as an example, is the largest company by market cap, hence its weighting is then proportional to the bucket of those 500 companies. Mm-hmm. And so what you're verbalizing is that back in the 60s, in 64, just 5 of the names made up about a third of whatever the index was doing.
Exactly.
Okay.
And in 2018, that was about 15%, so almost half of what it used to be.
but wait a minute, Jack, the narrative in this market is that you got these 5 or 10 stocks that are completely taking over the market, and this has never happened before.
Yeah, it's pretty much always been like that.
There goes the media doing its usual, okay?
But perhaps in this case, it maybe not has happened that the stocks that are at the top right now are really pushing the market forward.
There's maybe an excellent point is, you might have these stocks that, let's say it's 15%. You'll give us the updated stat maybe, but it's like what's happening now is those are the stocks that are really moving. Yeah. And so it's kind of pushing this narrative that, only the big stocks are doing well right now.
Yeah.
Right?
Yeah, definitely. And it goes along with what Mark was saying too at the beginning of how the worst performers are continuing to do worse.
Yep.
And the best performers are continuing to do better.
Yes.
It makes sense going along with this distribution.
Yes.
Yeah.
It's interesting.
Yeah, it's very interesting. It goes along with pretty much like almost anything you can find in nature. Yeah, it also goes along with like Monopoly games, the board game.
Yeah.
At the end of the board game, one person has all the money and everyone else is broke.
Usually that's how it works, right?
Yeah, exactly. If you can make it that
If you can make it that work. So what's your source on the data so people know?
Yeah, so I found all this stuff from two main sources, the irrelevantinvestor.com.
That's going.
And the wealthycorner.com.
Good.
Yeah.
Okay. I'm sure Jenna will be able to put that up for you. For our YouTube viewers, it'll be in our traditional show notes. For our podcast listeners, all of our show notes are accessible on our social media sites. And so it's going to be Facebook, Twitter, LinkedIn, etc. That'll all be on there.
Yeah.
Anything else you want to discuss on this?
Yeah, just one more thing. So what's the takeaway from this, right? Basically, there's going to be a couple stocks that are going to be leading the market, and that's going to be pretty much a stable truth. But the good thing is that those stocks they have a high turnover rate.
Yes.
Because while yes, they grow exponentially for a little bit, after that they kind of peter out and they end up not doing better than the market does, right?
So like 2022, the top performer is not the top performer this year.
Exactly. And so like even 10 years ago, I think like only Walmart and Exxon are the top 10 that
are still in it.
That are still in the top 10 of the S&P, right?
Yeah, by market cap.
Yeah, exactly. So that's good for investors though, because that means there's a high probability, if you have a diverse portfolio, that you have some money in the next big name. So I like that. It's a hopeful outlook.
That's interesting the way you put it. I like that. And again, we just got to remember, the media still likes to quote the Dow Jones Industrial Average. Mm-hmm. And we got to remember the Dow Jones is a price per share weighted index, which is completely doesn't make any sense to me compared to a market cap weighted index makes sense to me, right?
Yeah.
But obviously the Dow gets a lot of media time because of sensationalism, in my opinion, of saying the market's moving 600 points. It's a lot more boring when you say it's moved 0.4%.
Yeah,
right?
Exactly.
So again, that's why we tend to quote the S&P 500 index more on our podcast. Anything else?
No, that's all. That's all I have. Hopefully that was interesting.
Very interesting research. I'll leave that topic with, as a reminder again, no recommendations for or against individual securities such as Apple or Tesla, some of the names you mentioned. Yeah. Those just tend to be higher weighted securities within the index. I always say that anytime we talk about individual names in the podcast.
Yeah.
So as we sign off, again, as Mark said, we're going to enter earnings season for the second quarter of 2023. The banks, Jack, tend to kick off earnings season the second week of July. And so we'll get a lot of those earnings. It's going to be interesting this year because coming off of the banking crisis at the middle and end of March, I'll be really curious to see how these banking earnings come in because the financial sector, there was a lot of optimism that the financial sector by Wall Street was going to be a good performing sector this year until March came around. And I'll be curious how those numbers end up coming out and how that affects the overall market. So we'll leave it there. Thank you for listening to episode 207 of the Independent Advisors Podcast. Myself, Mark, Jack, Jenna, we hope you all have a good, wonderful rest of your week and a good 4th of July.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.